Investment plays a central role in the broader world of real estate, building directly on the concepts you learned in earlier chapters about value, financing, market behavior, and economic forces. Up to this point, you have examined how real estate gains worth through appreciation, how buyers finance property through lending systems, and how national market trends shape pricing. This chapter brings those concepts together and shifts your focus toward how real estate functions as an investment vehicle. Whether your clients are first-time homebuyers hoping for long-term equity growth or seasoned investors purchasing commercial buildings for income, these investment fundamentals guide how they evaluate an opportunity. Investment, in its simplest form, means taking something of value and putting it to work with the expectation that it will grow. The goal is to increase wealth without losing the original capital, a principle known as the conservation of capital. Yet, as you learned earlier from studying market forces and economic cycles, no investment is completely protected from change. Markets shift, financial conditions evolve, and personal circumstances influence both risk and reward. A professional salesperson must understand these dynamics to help clients make informed decisions that match their goals, risk tolerance, and level of involvement. Investment characteristics. Every investment contains 4 key characteristics: risk, return, management involvement, and liquidity. These features help investors determine whether an opportunity fits their needs. Risk versus return. In earlier chapters, you explored how market value reflects supply and demand. Investment theory is similar. The rule is clear. Safer investments generally grow slowly, while higher growth opportunities come with greater risk. If a client chooses a high-yield real estate investment in a rapidly developing area, they may capture large gains, but they also expose themselves to market swings, financing risks, and potential operational challenges. When a client opts instead for a very stable investment, such as a long-term government bond or a savings account, they lower their risk but also limit their reward. Investors continuously evaluate this trade-off. A buyer considering a rental property must weigh the potential rental income and appreciation against risks such as vacancy, market downturns, interest rate fluctuations, and maintenance costs. Management. Some investments require almost no effort, while others demand constant oversight. A certificate of deposit sits quietly and earns interest. A single-family rental property requires leasing, repairs, accounting, tenant communication, and ongoing market evaluation. A larger investment, such as a 20-unit apartment building, requires even more involvement, or the hiring of a property manager, which affects net returns. An investor must determine how much time, knowledge, and responsibility they are prepared to take on. Liquidity. Liquidity refers to how easily an investment can be converted to cash without losing value. Cash itself is perfectly liquid. Stocks and bonds generally offer high liquidity because they can be sold quickly through financial markets. Real estate, however, is less liquid. Selling a home or commercial building can take weeks or months, depending on demand, market conditions, and financing availability. An investor must consider how soon they may need access to the funds they plan to invest. Investment rewards. Investors pursue financial growth, and real estate offers several types of rewards. Some benefits arrive gradually, while others accumulate over time and are realized at resale. Income. Some investments generate recurring income. In real estate, this comes from rents collected on residential or commercial properties. A client might purchase a duplex, live in one unit, and rent out the other, creating a steady monthly cash flow. Investors can spend that income or use it to fund additional investments. Appreciation. Real estate often increases in value over time. When a client buys a home for $250,000 and sells it years later for $350,000, the difference represents appreciation. Market trends, improved neighborhoods, inflation, and property improvements all contribute to this growth. Leverage. Real estate is unique in that buyers can use a relatively small amount of their own money to control a large asset. A $20,000 down payment might secure a $200,000 property. If that property appreciates or generates rental income, the investor benefits from the full value of the asset, not just the portion they personally funded. Tax benefits. Tax treatment can enhance investment rewards. Depending on the property type and the investor's financial situation, deductions may be available for mortgage interest, depreciation, repairs, property taxes, and other expenses. These benefits can reduce taxable income and increase overall returns. Investment risks. Every investment carries risks. These risks stem from economic conditions, market forces, financing environments, and unexpected changes. Market risk. If demand for a property declines, its value may fall. A commercial building in an area with rising vacancy rates may experience lower rents and reduced buyer interest. Business risk. For properties connected to a business operation, such as retail stores or hotels, poor business performance can reduce income and affect value. Purchasing power risk. Inflation can decrease the real value of money. If prices rise faster than an investment grows, returns effectively diminish. Financial risk. Interest rates and financial market conditions influence investment value. Rising interest rates may increase mortgage costs, reduce affordability, and dampen demand. An investor relying on leverage may discover that the cost of borrowing exceeds the income produced by the asset, creating negative leverage. Types of investments. Investors can choose from a variety of investment types, each with unique characteristics and rewards. Understanding these categories helps real estate professionals discuss how real estate fits into an overall investment strategy. Money investments. Money-based investments include certificates of deposit, savings accounts, and annuities. They offer stability and modest interest returns. Clients who prioritize safety often choose these options, accepting slower growth for lower risk. Debt investments. Debt investments include bonds, notes, and mortgages. The investor purchases a debt instrument and receives interest as compensation. Debt investments generally carry moderate risk. Equity investments. Equity investments involve purchasing ownership, such as stocks or mutual funds. These investments offer dividends and the potential for share price appreciation, but they come with higher risk. Real estate investments. Real estate can function as either a debt or equity investment, depending on structure, financing, and ownership. Real estate investors generally choose between two broad categories: income-producing property and non-income property. Non-income property includes primary residences. The reward comes primarily from appreciation, and in some cases, tax benefits. The homeowner gains utility and potential equity growth, but does not collect regular income. Income-producing property includes rental homes, multifamily residences, office buildings, warehouses, and retail centers. These assets provide income, appreciation, leverage opportunities, and tax advantages. Investors purchase such properties primarily for financial gain rather than personal use. Review summary. Investment fundamentals help explain why people choose real estate as a long-term wealth-building tool. Every investment has characteristics such as risk, return, liquidity, and management needs. Investors seek rewards, including income, appreciation, leverage, and tax advantages. But they must also guard against risks such as market declines, inflation, operational problems, and financial pressures. Real estate fits within a broader range of investment types, offering benefits similar to equity and debt investments, but with unique features rooted in land, property rights, and market demand. Understanding these principles allows real estate professionals to guide clients toward decisions aligned with their goals and financial capabilities. Discussion: why is leverage considered one of the most powerful incentives in real estate investing? Answer: Leverage allows an investor to control a large asset with a relatively small amount of personal funds. Because appreciation and rental income are based on the full value of the property, not just the down payment, leverage increases the investor's potential returns. It also enables investors to expand portfolios more quickly. How does liquidity impact a client's decision to purchase real estate versus stocks? Answer: stocks can be sold quickly, often within moments, making them highly liquid. Real estate takes longer to convert to cash, which may not suit investors who need fast access to funds. Understanding liquidity helps clients choose investments suited to their financial needs and timelines. Why might a rental property be considered both higher risk and higher reward than a savings account? Answer: a rental property involves operational responsibilities, vacancy risks, maintenance expenses, and market fluctuations, making it higher risk. However, it can also produce rental income, appreciate significantly over time, and provide tax benefits, creating higher potential returns than a savings account. In what ways can tax benefits influence an investor's overall return? Answer: tax advantages, such as depreciation, mortgage interest deductions, and expense write-offs, reduce taxable income. This increases the investor's real return because money saved on taxes can be reinvested or retained, enhancing wealth-building potential. Closing remarks. Investment fundamentals shape how professionals evaluate real estate opportunities and guide their clients towards sound decisions. By understanding risk, reward, leverage, tax benefits, and the unique features of various investment types, you gain the ability to explain complex concepts in simple, practical terms. In later chapters, you will build on this foundation as you explore investment analysis, real estate income valuation, and national economic patterns that influence long-term property performance. Mastery of these skills will strengthen your ability to serve both residential clients and sophisticated investors with confidence.